Well, good afternoon. Happy Friday, July the 5th. Hope you had a great July 4th. Let's get right to the news of the day, and that is the non-farm payroll report coming to us from the Bureau of Labor Statistics. So we've been in this fight now for 2 years with inflation, trying to get inflation back down to the Fed's target rate of 2%. And because inflation has been so high, the Fed funds rate has had to remain high, and we've had higher mortgage rates, higher rates really for any borrowing across the spectrum. So we've really had our eye on inflation. But as this year has worn on, we've come to digest what's happening with inflation. We've shifted our focus to not just look at inflation, but to also look at labor. Why have we done that? Well, even if inflation is falling, but we have a really strong jobs market with upwards pressure on wages, it could reignite what they call boomerang inflation, which is a secondary wave of inflation. That's exactly what happened way back in the 70s and 80s. Our Fed does not want to live through that again. They want to make sure that they have inflation firmly back in the bottle. So as much as their attention and their words are on inflation readings, they're really watching labor to make sure that there's enough softness in the labor market to give them confidence they won't get that boomerang inflation. We got some interesting numbers earlier this week. We got the job opening labor turnover number came in right around 8 million. If you take a look at the trajectory of the JOLTS report, we are now right on line with pre-pandemic trends. You take the pandemic craziness out of the picture, and JOLTS has now returned to normal. Last Friday, we got personal consumption expenditures. That's the Fed's favorite measure of inflation, came in at 0.0 increase year over year. Doesn't get a lot better than that when you're looking for inflation moderating. So today was another important report. We could build on the momentum showing that, hey, we do have inflation and labor softening and under control, or would this be a wild card that sent the markets into a tailspin? Let's take a look at the numbers. This is the actual employment situation summary from the Bureau of Labor Statistics coming out today on July the 5th, and it's talking about the employment situation last month in June. And you can see here, it says total non-farm payroll employment increased by 206,000 in June. Now listen, the estimate was for about 190,000 jobs, so you might look at this and go, wow, that's a really upbeat economic report. We beat the consensus estimate by 16,000 jobs. But the devil is really in the details here, and let me walk you through it real quick. So 206,000 jobs created in June. It's not a robust report, but it is a strong report compared to consensus estimates. Unemployment at 4.1%. But dig down into this report a little bit, and I'm going to take you down into it. Take a look at this. Government employment rose by 70,000 jobs in June. The average monthly gain, and this is a really high average, is 49,000. So typically what we're seeing with our federal government is that we're adding, or in our local governments, is that we're adding 49,000 jobs per month on average. That's an incredibly high number. Here in the month of June, we added 70,000 government jobs. If you strip out the 70,000 government jobs from that 206 number, where are you? You're down in the 130s in terms of what private enterprise is able to create in terms of the job creation if we strip out the government jobs. And while that's an important footnote to this Bureau of Labor Statistics report, take a look at the one at the very bottom here. And when we talk about footnote, this is truly footnote. This is right at the end of the report. They issue revisions to the non-farm payroll report each and every month. They'll go back and say, hey, we missed it by a few thousand, either up or down, and you'll start to see these revisions. Sometimes it's 10,000 jobs, sometimes it's 8,000 jobs, sometimes it's 20,000 jobs, but they do go and they make these revisions. The last few have been in the downward trajectory. Take a look at this revision. The change in the total non-farm payroll employment for April was revised down 57,000 jobs, from 165 created to just 108,000 jobs created across all sectors in the month of April. The change for May was also revised down 54,000 jobs, from 272,000 created to just 218,000 jobs. With these revisions, employment in April and May combined is 111,000 jobs lower than previously reported. Guys, that is a massive miss in terms of percentages. You take in these revisions, we actually came in under consensus estimates, showing a lot more softness in the labor market than we previously anticipated. And when you factor in the government jobs as well, boy, we're really not seeing a lot of job creation at all. We think this puts a September Fed rate cut squarely on the table. The futures market would tend to agree with us, now up over 60% chance that the Fed will cut the Fed funds rate for the first time in September. And listen, the cut's probably only going to be 0.25%, but it's not the amount that matters. It's the action. It's the fact that the Fed will begin the Fed rate cutting cycle, and we will be done with this period of restrictive to hiking interest rates, and we will begin a more moderating or dovish Fed cycle. And that's exactly what interest rates could use. That's exactly what home affordability needs. If I can be of any service to you over the holiday weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.